90% of day traders lose money within their first year. Yet millions of people still think trading is their ticket to quick wealth. Meanwhile, patient investors quietly build fortunes that traders never see. Here's what's crazy. Both groups are using the exact same stock market, buying and selling the exact same companies. But one group consistently wins, while the other consistently loses. The difference isn't luck. It's not intelligence. It's something most beginners don't even know exists. Today, I'm showing you the real difference between trading and investing, and why picking the wrong one could cost you everything. Let's break it down. Trading is simple. Buy low, sell high, repeat. But here's the catch. You're doing this constantly over short time periods. We're talking hours, days, maybe a few weeks maximum. Traders don't care if a company makes great products or has a strong business model. They only care about one thing. Is the price going up or down right now? To predict this, traders use something called technical analysis. They study price charts, looking for patterns that might signal the next move. You've probably seen those candlestick charts with green and red bars. Green means more people bought than sold, so the price went up. Red means more selling than buying, so the price dropped. Traders spend hours studying these patterns, trying to spot trends before they happen. Here's a quick example. Let's say you're watching a stock trading at $50. Your analysis suggests it's about to bounce up. You buy 100 shares for $5,000. The stock climbs to $55. You sell for $5,500, making a $500 profit in maybe 2 days. Sounds easy, right? But here's reality. What if you buy at 50 expecting it to rise, but it drops to 45, then 40, then 35? You just lost $1,500. This is why traders use stop losses, automatic sell orders that cut losses before they get catastrophic. Investing is the opposite of trading. You're buying pieces of companies you believe will grow over years or decades. You're not trying to predict next week's price. You're betting on the business succeeding long term. Investors use fundamental analysis. Instead of studying price charts, they dig into financial statements, company earnings, profit margins, competitive advantages, and management quality. They're asking, is this a good business that will be worth more in 5 or 10 years? Here's an investing example. You research a renewable energy company. Their technology is innovative, demand is growing, management is strong. You buy 200 shares at $30 each, investing $6,000. Over the next 5 years, the company expands globally, revenue triples, and they start paying annual dividends of $2 per share. That's $400 per year in passive income just for holding the stock. The stock price fluctuates. Sometimes it drops to 25, other times it jumps to 40, but the overall trend is up. After 5 years, the stock hits $75. You sell your 200 shares for $15,000. Your $6,000 became $15,000, a $9,000 profit, plus $2,000 in dividends over 5 years. Total gain, $11,000. Comment invest, and I'll send you the one-page checklist to help you decide whether trading or investing makes more sense for you. Let's break down how these two approaches actually differ. Time horizon. Trading is short-term, measured in hours, days, or weeks. Investing is long-term, measured in years or decades. Warren Buffett has held Coca-Cola stock since 1988. That's over 35 years. Analysis method. Traders use technical analysis, focusing on price patterns and charts. Investors use fundamental analysis, studying company financials and business strength. Risk and stress. Trading is higher risk and requires constant monitoring. You could make thousands overnight or lose it just as fast. Investing is lower stress. You can buy quality stocks and check them years later as long as the business remains strong. Focus. In trading, the company's actual business doesn't matter. Only price movement matters. In investing, daily price swings don't matter. Only the company's long-term growth potential matters. Returns. Trading offers the possibility of quick gains, but most day traders actually lose money. Investing offers steady wealth, building over time, with historically strong returns for patient investors. Returns. Trading offers the possibility of quick gains, but most day traders actually lose money. Investing offers steady wealth, building over time, with historically strong returns for patient investors. So, which path should you choose? Here's the honest breakdown. Consider trading if you have time to monitor markets throughout the day. This is often like a full-time job. You can handle high risk and high stress without panicking. You're extremely disciplined about cutting losses quickly using stop losses. You've thoroughly studied technical analysis and understand market psychology. You accept that most retail traders lose money, and you're willing to beat those odds. Consider investing if you want steady long-term wealth building with lower stress. You have a busy life and can't watch markets constantly. You're patient and can resist panic selling during market crashes. You enjoy researching companies and understanding business fundamentals. You think in terms of years and decades, not days and weeks. Here's what smart people do. Many successful investors use a hybrid approach. They put 80 to 90% of their money in long-term investments for stability and wealth building. Then they use 10 to 20% for trading to potentially boost returns. This way, even if their trades go badly, their core wealth stays protected. Here's what nobody tells beginners. Without proper knowledge and skills, you're not trading or investing. You're gambling. And in gambling, the house always wins. Trading requires intense study of technical analysis, risk management, and market psychology. Even then, data shows most day traders lose money. The few who succeed treat it like a full-time profession. Investing requires patience and the discipline to hold through volatility. It's boring, it's slow, but historically, it's how ordinary people build serious wealth. The S&P 500 has averaged 8 to 10% annual returns over decades. That might not sound exciting, but compounded over 30 years, it turns modest savings into significant wealth. The biggest mistake? Trying to trade without the knowledge, losing money, then giving up on the stock market entirely. Or worse, panic selling investments during crashes and locking in losses. Bottom line, trading is fast-paced, high-risk, and requires constant attention. Investing is slow, steady, and builds wealth over time. Most people should focus on investing and only trade with money they can afford to lose. Subscribe for more honest breakdowns. Hit like and share with anyone confused about stocks. Comment, trading or investing? Which path are you taking?